Welcome to CFA Corner, the video series where we dive deep into the world of finance with Timothy Fitzwilliams, founder and CEO of Fitzwilliams Financial, and Ron Wright, the firm's portfolio manager, where we're unpacking the latest trends, insights, and strategies in the world of finance. Welcome, Tim and Ron.
Welcome, everybody, to another CFA Corner. Myself, Tim Fitzwilliams, founder and CEO of Fitzwilliams Financial, and our portfolio, Mr. Ronald Wright, our chartered financial analyst. How you doing, Ron?
Well, it's been a really interesting few days. But I'm still standing, and
That it has.
Good.
And that it has. And I think that's why you and I discussed kind of doing this impromptu call, because we wanted to let our clients know what we're thinking, what's going on, and essentially not to freak out. You got your eye on the prize and we're watching things. Because there's been a lot of economic and financial market activity just in the past week, right?
Yeah, absolutely.
So let's start things off. Everybody wants to understand kind of where we are now, but how we got there and what we're looking at. We've been looking at it for a while now, which is inflation. And so that's supposed to have been decelerating. What's going on there as it reflects rate cuts, and then, how the volatility is playing into that?
Sure, absolutely. So, the Federal Open Market Committee, the FOMC, met last week, Wednesday on July 30th. And of course, the major thing that they've been looking at is inflation. How quickly are we bringing inflation down? Is it working? Or are we going to get this sudden reinflation problem? So they're watching it very closely. And what the statistics have shown us is that inflation is indeed coming down. It's come down quite a long way. It's getting close to their target. The preferred measure that the FOMC has is the core PCE deflator. So PCE stands for personal consumption expenditures. So the core strips away the effects of energy and food and looks at just at every the rest of it. And that's what the Fed looks at and measures. Their target is 2%. It's sitting about 2.5% right now. So we're really close. We're approaching it. And so the Fed has finally said, okay, maybe we're okay here. Now it's slowed. It was coming down really fast at first, and that has slowed, but it's still moving in the right direction. So they're in good shape there. And of course, we've got really restrictive monetary policy right now, with the Fed funds rate at 5.25% to 5.5%. So that's very high, and that's why everything is slowing down. So at their meeting, they came out and they held rates steady at this meeting, but they at least opened the door on that day towards the idea of beginning rate cuts in September. And
right, we've been talking about that for a while now, right? We've been talking about having 3 cuts this year, but I understand that may be changing because some other news that's come out is that after Wednesday, Friday happened, right?
Well, in
that's
between there,
second, and that's where the bad news comes in. You want to just kind of talk a little bit about the unemployment rate and how that affects things?
Right. So in between there, the markets rallied hard. It was a really strong rally. Prices went up. Everything did really well because they thought, okay, the Fed is finally on our side, and spending is going to be good.
Between Wednesday and Friday, we're talking about the markets rally.
Exactly. Yeah. Exactly. So that looked really good. Friday morning, there was everybody was waiting for the employment situation report. So we wanted to know how many jobs have been created, and also what was the unemployment rate, because these are the two gauges that we're watching on the other side. And the Fed did say in their statement that they're starting to have a little bit of concern that there's risk to growth, which means they're watching the employment numbers. So people were closely monitoring this release. The expectation was for the unemployment rate to hold at 4.1% and for about 175,000 plus jobs to be created. There was some whispers of maybe it would go as low as 144,000 jobs, but that was considered to be the really low. When the news came out, it was 114,000 jobs that were created, and the unemployment rate jumped from 4.1 to 4.3%. So that's a huge move on the employment rate, and a really disappointing increase in jobs.
Okay, could you speak to that in terms of there's a decrease in jobs, of new jobs, which is a slowing of the economy, and that kind of goes right back into the idea of this 2.5% inflation rate as opposed to the target 2. We're seeing the slowing, and so when you see additional slowing, such as the unemployment rate, it's kind of telling you you're starting to get past the point of where you want to get, that the next thing you see might be even more slowing. So that's a really good indicator to say this economy has kind of come to a standstill.
Right. Yeah, exactly. That's what we don't want. We don't want the Fed to keep policy restrictive for too long, which would throw us into that recession. And that is, of course, right now exactly what the fear is. So a couple of important things on the unemployment rate. One way is a good way to look at this is what is the percentage change over the last 12 months. So sometimes it's hard to understand the gravity of it when you just look at a 4.3% rate. But when I tell you that over the last year, it has increased by more than 23%, that's a big move.
That is a big move.
Unemployment has risen by 23% over the last 12 months. That's a pretty substantial move. The other thing that represents is there's a more obscure economic indicator that's called the SOM. It was created by Claudia Somm, who was a Fed economist and was a member of the FOMC for a while. And basically what it does is it looks at the 3-month average of the unemployment rate. And anytime that 3-month average increases by more than 0.5%, that's an indicator that either we're already in or a recession is imminent. And I have to tell you that indicator since 1950 has never failed. It's
Wow.
Every single time. And it just triggered when we hit an unemployment rate of 4.3%.
And you said that's an average, right? Because you said it was a 23% increase in the last 12 months, but is it the average per month?
Yeah, it's a 3-month average. Yeah.
Okay.
It's
so a 3-month average, more than 0.5 point, according to this report, indicates that there's a recession. And how far? Like now? Like what does the rule say as far as the timing of the recession relative to that rule?
Yeah, good question. And if you look at the history, it's either within months or you're already there. So it's imminent.
So when was the last time this was triggered?
I believe the last time was probably not a surprise, the pandemic. Yeah, the pandemic recession. I'll just look at the numbers here. And of course it would be triggered then because that was...
Yeah, that makes perfect sense.
Jumped insanely high and that was definitely a recession. So, but it has been accurate in every other instance. So this is being talked a lot about and a lot of attention was paid to it by market participants. And so what happened was on Friday, we gave up all the gains we had on Thursday and then some. People started selling their tech stocks, their high flyers and bonds rallied because there was an immediate repricing of expectations of what was going to happen. So if you remember back at the beginning of the year, we were talking about as many as 6 rate cuts in 2024, that we would end the year with at least 6 rate cuts. Then throughout the year, that kept getting cut back and back and back to where at some point there was even people talking about maybe the Fed has to raise rates one time this year. All that has been erased. We're back to 2 to 3 rate cuts in September and 5 to 6 rate cuts by the end of the year.
Wow.
So in one...
For a total of what? What's the total looking like, Ron?
So that would take us down to, 1.25% lower than we are now. So down towards 4% by the end of the year. And the expectations in the marketplace for what they call the terminal rate, where we're going to get to in this cutting cycle, is 3% to 3.25%. And that's by the end of next year.
Okay, so by the end of next year, the Fed is stating that they want to be around 3.25.
Well, that's what expectations in the marketplace are.
Oh, okay, that's the futures market. That's what they're showing. Okay.
Exactly.
I got you. Okay. The Fed hasn't really stated that. Are
Well,
they?
actually, yeah.
What
The
are you
Fed has,
tracking? Yeah. What are you tracking for what the Fed is saying? I know you track that a lot.
right, yeah, absolutely. So the Fed has a target of about 4.1%.
Okay. So a little bit less, but still a major difference from where we are now.
Oh, yeah. Well, that's a full 1% less. That's
Absolutely.
25% lower than what the Fed was forecasting just a couple of months ago. So
Gotcha.
this was a major repricing of everything.
And so, what was the result in the market? They were selling off the tech stocks, which we believe there are a lot of them are overvalued anyway. And unless your finger's on the trigger on a daily basis, it's a dangerous game to play because you got to be able to get out. And Ron, you did that, right? You had to get out.
Yeah, we saw what was happening, so we decided it was time to take some risk off the table. We have profits in all these positions, so it was time to gather in some of those profits and take those profits and then we raised about 13% in cash across our equity portfolios.
And that was Friday.
That was Friday.
So I just want to cover a timeline for the folks and the clients listening, or people that are just wondering what's this whole big deal about, having a CFA and this, small mom and pop firm, what have you, and all this, right? The Friday, the report comes out, right?
Yeah, Friday
And
morning.
you had made an actionable event in people's portfolios the same day.
Yes, that same morning.
That's fantastic. I mean, that's not normal. No one's going to get that. They're going to be having the conversation, calling their advisors. I'll be honest, we haven't got many phone calls at all. I don't even think we've gotten any. I was checking with Brian. I know he's on vacation right now, but he's like, I didn't get an email. And I really feel that's a testament to how fast you're moving. I think that's awesome. I know you do the weekly rebalancing, but what's not said is that if something's going on, it's daily. You're on it.
Yeah. We've been joking for some time that we were fully invested, but with our finger on the sell button, waiting.
You said you were driving in fog. You said it in the newsletter. You were driving in fog, and we don't know where the edge of the road is. And here we are, maybe one wheel off. So you had to do something. And that's a now thing, folks, which I'm so excited about and proud about to know. People always ask me, are you worried about it? Not at all. Not if somebody's watching it every day and can make or stop losses in either direction, up or down, which is just a beautiful thing to have. So we're very grateful for your attentiveness and your commitment to the portfolio. That had an effect, which is a play that we've been talking about for a while now, right? Was that the bonds would start to rally. For those that have been tuning in and those that have been listening to us about this theory, is that as these rate cuts happen, because in 22 the bonds got so crushed as interest rates went up, now if rates cuts happen and interest rates come back down, bonds are going to go back up. And I think you were saying we saw a little bit of a rally of that, a start maybe to that engine.
Yeah, we saw actually there was a significant bond rally on Friday, and so we didn't have to make any adjustments to our bond holdings, only to the stock holdings.
Right.
And having those bond positions gave us even more of a hedge against the downside for when the market was selling. So it worked exactly as intended. And also, we're diversified in our approach, so we're not all in these super mega cap, large tech stocks. We're
Right.
across. We have many positions across other sectors and other styles. So all of that worked together in our favor and worked as it's intended.
That's fantastic. So Friday comes, Friday goes. The weekend happens. Can you walk us through some of this international stuff going on with the yen and Japan and what happened in the weekend and this whole talk about, as bad as Black Monday with Japan?
Yeah, I wish I could say that Friday was the end of things, and that was the sum total of all the craziness. But it was really just the beginning. And what happened on the weekend was people began to anticipate what these interest rate shifts were going to do and how that was going to affect different things. So let me set the stage with this. The favorite trade of speculators, private equity, hedge funds, one of the favorite trades lately has been to borrow money by selling Japanese yen and getting US dollars, and then putting those U.S. dollars into these Mag 7 stocks, cryptocurrencies, Bitcoin, Ethereum, those sorts of assets, because they're
borrowing. Just to be clear, everyone heard that because you say it and you're so technical. I just want people to understand they borrow the money.
They borrow the money,
and they're in a leveraged position.
They sell yen, and that's, which means they have to pay it back at some point. They're going to buy it.
Yeah, exactly. Somebody could call at any time, right?
Right. And it was a great trade because the yen had been dropping and dropping and dropping in value, and the U.S. dollar, has been gaining and gaining and gaining in value. So it was a great trade as long as it lasted. But the problem was that it suddenly turned, and the yen started gaining very quickly, and all of these positions had to be unwound. In other words, the people that had sold the yen to borrow the dollars got phone calls from their banks, their investment banks, saying, "Hey, it's time for you to pay us back," and that's today. You need to pay us today. So they had to come up with the dollars to convert to yen to pay it back.
Now you're forced to sell your holdings in those volatile stocks that just got crushed on Friday.
Exactly. So on Monday morning, the futures, as we opened, the futures on the NASDAQ were down nearly 6%. Right at the very open of the market. We had stocks like NVIDIA were down 15% or more during the day. It was very crushing. And it did recover somewhat, but at its extreme, it reminded me of the conditions that we faced during the financial crisis, the dot-com bubble bursting. It looked very, very similar, had the same kind of feeling.
And for Japan, that was what people were saying was the worst day since Black Friday, Monday of '87.
That's exactly right. It was down, I believe, 26%.
Okay. Now, why did it appreciate? What are your thoughts there? I mean, that was the triggering event, right? The yen appreciated, which was unexpected. Now the bankers want their money back. Got to go sell the NVIDIA. Got to go sell the Apple to go give the bankers their money.
So it appreciated because currencies are valued based on several different factors, such things as inflation with differentials between countries, and also interest rate differentials between countries. Mm-hmm. So as the United States looked like they were suddenly going to be cutting interest rates, Japan has been very slowly increasing interest rates. So all of a sudden that interest rate differential shifted dramatically to value, or to give more weight towards the yen, and it pushed the value of the yen higher very quickly. And that's what brought all this together. And when you add leverage to this, when you add maybe 10, 15, 20 times leverage,
right,
it buys that event by that rate, and it's very punishing to those that are on the wrong side of the trade.
I can only imagine. And then because it's such a large organization, if we want to call it that, in framework, it's a large organization making this trade.
Yeah.
That then creates a major ripple in the marketplace. And that's what causes the global markets and the huge sell-off, right? That's on this Monday we're talking about.
Right. And most people don't understand what you say yen carry trade. It doesn't make much sense.
Well, who's studying that? I mean, the average person's like, "Oh, I self-manage," and the truth is, we all know it. They're watching a few charts and they're watching CNBC and looking at things and just going with the flow on what feels good and what people are hyping up on those channels. No one's talking about some random currency trade event that's happening until it's already happened, and then it makes the news.
Exactly. So you've heard about it.
That's scary. It's those things that you're not expecting, the black swan type stuff, the stuff that's out there, right? And so you monitor this black swan, this feeling of anxiety or fear in the market via a certain index, right? And you monitor that closely. I know we've had conversation about that. Can you kind of share a little bit of how that peaked and what your findings were on the VIX?
Right. So a lot of people are familiar with the VIX. It's also known on Wall Street as the fear index. And what the VIX does is the actual math behind it is rather complicated, but it's pretty easy to understand where they're coming from. And what they do is they measure the premium for options on the S&P 500 stock index. The idea is when volatility, the market swings get higher, that premium increases. So and you can kind of watch it the other way around. If the premium is increasing, then volatility is increasing, and that is why they call it the fear index. The idea that I want to protect myself if the market's going to go crazy in one direction or the other. So we watch this index, and it's been almost sleepy for the past few years because, as everybody knows, it's been pretty calm. It's been going in one direction more or less. On Monday, the VIX index spiked higher by 181% intraday. 181%, almost tripled from where it was.
Wow.
So it's an amazing thing to think about.
That truly is. So then that brings us to, I think I was having an interruption there. Sorry about that. That brings us to our present situation and our strategies and what you did on Friday when you heard the news, or rather when you were watching it happen, not heard the news, but you were watching the news and studying it, made your move. You said you took profits off the table from tech to reduce exposure. Mm-hmm. And talk a little bit about where we are today. What are we holding? And what was the loss difference? Right? Everyone wants to know, okay, well, he did that. How much did that help?
So, for right now, where we are, we're watching, of course, because there's no indication that this move is complete, that this unwinding is complete. So we want to still be careful. There's always a group that want to go out there and what they call buy the dip, right? They're waiting for the opportunity. Right. But this was a move of such magnitude and the ramifications are so broad that this thing has to be monitored, and some patience is really required here. So we have the cash that we raised on Friday, and we're watching for where to redeploy it. We're looking at more defensive places to redeploy it because we don't want to get caught up in this kind of madness again.
Right.
How that works for us was on Friday, because we have more diversified portfolio and we had this extra cash in there. Our equity positions lost about 1/3 less than what the broad market did. And yes, and as a whole, we look at all client accounts and our total assets that we manage. We're less than half of the losses of the broad market.
Okay, that's awesome. So that's very comforting. So if you're out there wondering, are we doing anything? Is your advisor working? Is stuff happening? The answer is yes. And our claim to fame is always to lose less in times of market volatility. And here we are, again, proving that it's happening again. This isn't the first rodeo. Just did it in 22. We're doing it today. People are like, oh, but that's just one day. Ladies and gentlemen, depending on when you got into the market and whatnot, it could be a major impact on you. And these one-day changes, wouldn't you agree, Ron, are what really gives you that extra cash at the end because you made the right move at the right time because you're studying it.
Right. Yeah, we're not waiting for things to get so bad that there's no point. We want to make sure and be there ahead of time so that we can slow that volatility for our portfolios and mitigate those losses.
Now you feel, kind of been wrapping things up. Mm-hmm. The Fed's met. There's been some more slowing with the unemployment. So now we know that they're going to go into these cuts, or at least we feel rather confident they're going into these cuts. We think that there's going to be, 4 to 5 here, as we were talking about, 2 to 3 in September, and then another 5 to 6 by the end of the year, right? Total of 5 to 6 by the end of the year, if I understood. Yeah. Mm-hmm. Yeah. And ultimately around 3% is where the Fed is thinking it might be, and the markets are the Fed thought 4%. Is that what it was? And the markets were thinking about 3?
Yes.
Okay, so the recap, Feds think 4, markets think 3, 5 to 6 cuts by the end of the year. That's kind of where we're at right now.
That's kind of where we're at, yeah, right now. Exactly.
Outlook on the future, volatility still driving in the fog. I would imagine that you're more concerned than ever with what's happened recently that there might be more volatility. How are your
Yeah,
thoughts on that now?
absolutely. And so we're having to hold the cash right now because we've got that deployed in funds where we're making 5% with, in money market funds. We are looking at any hedging activity that we need to do. Those are already planned, and the the trades are laid out already. We can implement those immediately at
I
any
know.
time.
I hate to interrupt. I got to interrupt, but I was just down there hanging out with you in beautiful Coral Gables, Miami. But by the way, folks, we just opened a branch down there. So if you have any friends or family that needs help and you want that, hey, only if you're in my backyard thing, we're in Coral Gables. Ron's down there. We're down there. We're loving it. But I walk into his office and he actually has an Armageddon list. I couldn't believe it. Like a plan that if it all goes crazy, you're ready to move. I thought that was awesome. So, as you're saying, you have these strategies lined up for every type of movement, and that's fantastic. And we're grateful to have that type of attention for our accounts. And you don't have to have $10 million. Everyone knows you don't have to have that type of money to have that type of resource and that type of expertise being applied to your accounts, which is such a blessing to so many people. So you're cautious. And you're thinking there might be still some sell-off. You think that there could be some more volatility and some sell-off?
Yeah, I think so. And today, here we are, Tuesday, after the big sell-off day,
Mm-hmm.
and an indicator of that is the end of the day, the market just sold off by about 1% from where it was in the last 15 minutes. So there was no conviction that
Last
this is
15
going.
minutes. Wow.
Yeah, so it gave up 1% of what it had clawed back. And still, we're a long ways away from
Mm-hmm.
recovery, but we have lost in just over one day.
So this is our biggest concern is we're in the rapids. Now we're in the turbulence. We're in the one moment in time where you don't want to be piloting that aircraft or driving that boat if you don't know what you're doing.
Yeah. Oh, yeah.
This isn't, I'm going to turn on CNBC time. I'm going to watch Bloomberg. By the time all that happens, it's the age old story. It's too late, right? You got to be deeper than that and watching futures markets and really understanding what you're watching, not just hearing about it and go check it out, but really understanding. I mean, to pivot that fast, that's what's required, right? Do you feel like you could do it any other way and have similar results?
I don't think so. And that's why we do what we do. That's why we put this
Right.
whole program together and the models that we
Absolutely.
use, because we feel like this is the only way to rationally manage your money.
So let's end on a rational note about the interest rates being cut. We've been talking about it for a while. The bond market has an upside. What do you think we could still make in that for people that are wanting to be a little more cautious, lean toward bonds? What are you thinking that would look like now, with the type of rate cuts that we were discussing today?
Of course, we have to say nothing is guaranteed here.
Absolutely.
Conditions
Nothing's
can change.
guaranteed.
We've seen them quite a lot, very rapidly. But given the outlook that we have, I think that it's reasonable to expect that the bonds, which should be a less volatile instrument to trade, could bring in 9 to 12% over the next two years.
So it could have. You still feel it could have stock-like returns. You still feel confident that eventually, as interest rates come down, bonds are going to go up. But that's again something you just can't go out and watch a show or hear a speaker talk about, or just pick one. You really got to have some expertise in that too, right? It's not just going to be everything's going to go up like that.
Correct. Because as you mentioned, the bond market is 3 times the size of the stock.
Right.
So there's a lot of different bonds out there, and there's a lot of variability in where to go. So it's also a matter of picking the right place and holding the right portfolio for those bonds.
Fantastic, Ron. Well, I think that's pretty much what we wanted to talk about. Really appreciate you on the impromptu right after the market, jumping in here and just trying to let our clients know that, hey, you're being taken care of. We're watching this daily, right? And you've got one of the best monitoring that. That's in our opinion, right? But, actions speak. And something happens Friday and he's making moves on Friday. I mean, that I think sums it all up right there. So again, thank you for your time, Ron. I'm looking forward to see what you have planned for us as we move into things. I'm excited to still see that big bond rally. I'm hoping that comes to fruition. For everyone else, this is Tim Fitzwilliams and Ron Wright with the CFA Corner. God bless. Until we talk again. Take care. Goodbye, everyone.